think generally the stock market is a complete waste of time and a way to lose a lot of money either very quickly or slowly and painfully over a long duration of time. However, it is still fun sometimes to look at historical stock prices and manipulate them and look at them in different ways to see if you can maybe decipher a pattern or possibly a profitable trading strategy. And in this video, I'll show you how to do that. You need three things to analyze stock data and hopefully devise a $1 million stock trading strategy. They are the stock data itself, a program that can accurately manipulate the data and apply your ideas to it, and most importantly, a brain or an imagination to think of creative ideas to apply to the data.
To gather the raw stock data, I use Yahoo Finance, and I use a spreadsheet program to analyze the data and apply my strategy ideas. In this case, I'm using a free program. It's called OpenOffice Calc. So let's try an example. For instance, let's say I think that Apple stock, if it goes down 3 days in a row, then it will go up the next day and then down again the day after that. So I'll write that down in my spreadsheet. If Apple, that's AAPL is the symbol, goes down 3 days, up on the 4th day, and down on the 5th. Okay? Sounds easy enough. So our next step is to get some Apple stock data, put it in a spreadsheet, and then apply that strategy to that data set so we can see if it works in the past, and if it works in the past, we'll cross our fingers and hope that it works in the future. To obtain the raw stock price data, I use Yahoo Finance, and I enter the symbol I'm interested in the search bar. In this case, it's AAPL. And I go to the left side navigation and click on Historical Prices. And Yahoo Finance has a nifty feature. If I scroll to the bottom of the screen, it allows me to download the entire history of the stock into a comma-separated spreadsheet document. So I can click on this and save it. And once it's done downloading, then I have the data on my computer. Once the data is finished downloading, I can import it to my spreadsheet. And there it is, all of the information for Apple stock. Now let's apply the strategy. I'll start by making a column here, and we'll call it Today's Movement. And this will represent the difference between the close price of the day and the open price of the day. In other words, the profit or the loss if you would have bought that stock today. So to do that, we'll do equals, and we'll click the close price minus the open price, and it shows that on June 5th, 2012, the Apple stock moved $1.56 up. And then we'll copy this formula and then select all these cells here, and paste, and it warns me and I click yes. So now we have all of the movement per day of Apple stock in this column. In this next column, we will write a formula to indicate that the stock price has gone down for the past 3 days. So we'll title the column 3-day down. And we'll write it like this: equals, and today's movement was less than 0, and also yesterday's movement was less than 0, and thirdly, the day before that was less than 0. Oh, this one should be a semicolon. And it says false because the conditions were not met. This day and this day were both above 0. So we'll copy and paste the formula. And as you can see, there are a few instances where the conditions occur. Now that we have an indicator that lets us know when there have been 3 consecutive losing days for the stock, we can write a formula that keeps track of what happens on the 4th day. So we'll call this column 4th day up. And we will word it like this: equals, if the previous day was the 3rd consecutive down day, then we will buy the stock on this day. If not, nothing. And then we'll copy and paste this down the column. And as you can see, there is some activity just fairly recently, and actually it happens fairly regularly that there are 3 consecutive down days. And predictably, we'll call the next column 5th day down. And for this one, we'll say if the day before yesterday equals true, then here's a trick: negative today's movement, because since we're predicting that the stock price will go down, we would be shorting it that day, so it would be we would profit if the stock goes down, so we use the negative. And then if not, 0. We'll try that one on. And as you can see here, I have some more entries. On a few of them they overlap, because on these few days it went 3 days in a row. It went over 3 days negative. We had a bunch of days of negative. So sometimes we'll have different trades going in different directions. Like for this one, it would trigger a long trade and a short trade. So it would we wouldn't trade at all that day. We would just we'd decide to take a rest from the market, because we'd have triggers going in both directions. The next column we will title total profit, and it will just be an addition of the trades from the 4th day up and the 5th day down. So we'll say equals this plus this. And this last part is the fun part. We get to see how it performs over time. We'll call this next column accumulation. I don't know how to spell it, but accum. And we'll go all the way down to the bottom where we start, and we'll say equals the previous day plus today's profit or loss. Now this is really handy because if we copy and paste this all the way up to the top, it will show us what happens. Oh, and it looks like it does have at least a positive profit margin over time. Now another trick is we can do a chart. We can select the whole column and click chart and see what the equity curve looks like over time. And we'll just finish that up there. And this is what it looks like. It really goes crummy for, well, it's a 10-year chart, so for 5 years it doesn't do anything, and then for some reason it goes up. And I don't know, that's not something I would want to trade particularly, because you can go 5 or 6 years without anything, and this doesn't even take into account the spread or the brokerage fees either. So I've made some changes to the spreadsheet. I've modified the total profit column to reflect a deduction of 10 cents in the event a trade was made. This is to cover transaction costs and brokerage costs and the bid-ask spread. It might be more than 10 cents, it might be less. This is just an arbitrary number to make it at least a little bit more realistic. I've also done a calculation here called shares available. Basically this just shows with any given account balance how many shares you could buy with that account balance. And then this column represents 50% of the shares, so rounded because you can't buy partial shares. So this just shows that with this much money I could buy 6 shares if I wanted to risk 50% approximately of my account. And the whole reason for both of these columns is to give an idea of if you started with a dollar amount down here, $5,000, how the account would grow or shrink over time if you risked a certain portion of it throughout that whole time. So see, when Apple was very cheap, I could have bought 350 shares, but only risking half of the account balance. You would only buy 176 on that particular day if there was a trade to make, because you don't want to risk your whole account in one day. So if you want to look at the chart for the duration, taking into account the account growth and the fees, it looks like if you started out with $5,000 and you traded this strategy, it will kind of wallow around a little bit, and then you'd end up a little bit above 6,000. I personally would not trade this strategy. It's way too simple, because if it worked, then a million people would be using it, and that would make it not work anymore. But hopefully the video has been helpful for you, and thanks for watching.